This video is about how to start day trading. This is for beginners, so make sure you like and subscribe if you like this content. In June of this year, the rule that required you to have $25,000 in your account to day trade stocks was eliminated. Gone, which means a lot of people are starting this month with a small account who couldn't a year ago, so this video is for you. I'm going to cover what day trading actually is, what you need to start, and what it actually takes, including the part most of these creators leave out, which is that most people who try this lose money. I'm not going to sell you anything. Let's get into it. Day trading means you open and close a position in the same session. You don't hold overnight. Whatever you bought at 10 in the morning is closed before you shut your platform down. That's the entire definition. Same day, in and out. Here's how it sits next to the alternatives. Investing is holding for months or years. You're buying a business and you're betting on it over time. Swing trading is holding for a few days to a few weeks. You're catching a move and you're comfortable with overnight risk, meaning news can hit while you're asleep and you wake up to a gap. Day trading is this: minutes to hours. You're flat at the end of the session, so overnight news can't hurt you. That's the main advantage, and it's a real one. The trade-off is that you're making decisions fast, on smaller moves, over and over, which means execution matters a lot more and mistakes compound a lot faster. You can day trade three main things: stocks, shares of a company; straightforward, everybody understands it; options, contracts on a stock; more leverage, more moving parts, and there's a lot more that can go wrong when you don't understand them yet; futures, contracts on an index or a commodity. Before we get to brokers and platforms, I want to be straight with you about something, because if I don't say it now, the rest of this video is dishonest. Most people who try day trading lose money. That's not me being negative. It's the consistent finding every time anyone studies it. Academic researchers pull broker records across whole countries, and the large majority of retail day traders lose. A small minority make money consistently. That's the shape of it. Now, the reason I'm telling you this towards the beginning of the video instead of burying it in a disclaimer at the end is that if you understand why people lose, you can actually do something about it. So here's why. 1. They're undercapitalized and they trade like they're not. Somebody funds an account with $2,000 and then risks $400 of it on a single trade. 3 losses in a row, which is completely normal, it happens to everyone, and they're down more than half. Now they're not trading a strategy anymore, they're trying to get back to even. That's a different game, and it's one you lose. 2. They don't have an edge. An edge is a specific, repeatable reason you think price is more likely to go one way than the other, that you've tested enough times to trust. Most beginners don't have that. They have a feeling and an indicator they saw on YouTube. Those aren't the same thing, and the market charges you tuition to learn the difference. 3. Revenge trading. You take a loss. It stings. So you immediately take another trade, bigger, faster, worse, to make it back. This is the single most expensive habit in this business, and almost everybody does it at least once. The people who survive are the ones who stop doing it early. 4. They treat it as income before it's a skill. If you need this month's rent to come out of the market, you will make bad decisions. Not might, will. Pressure ruins execution, and the market does not care what your bills are. None of that means you can't do this. It means going in with your eyes open is worth more than any setup I could teach you. All right, practical. Capital. As of June 4th, 2026, the $25,000 pattern day trader minimum is eliminated. The minimum to hold a margin account is $2,000, same as it's always been for any margin account. One thing to know, brokers have until October of 2027 to fully implement the new framework. So some are live with it already and some are still phasing it in. If you open an account and it's still counting your day trades, that's your broker's rollout, not the rule. And futures were never subject to that rule at all. Futures traders have been day trading small accounts this whole time. A broker. You want low or zero commissions, a platform that doesn't lag, and reliable fills? Don't spend 3 weeks researching this. Pick a mainstream one, open the account, move on. Charting. You need something to actually read price on. TradingView's free tier is fine to start. Most brokers include charts too. One market, not 5. Pick one instrument and learn how it behaves. Every market has a personality. How it opens, how it reacts to news, how much it typically moves in a day. You can't learn 5 personalities at once, and beginners who try end up knowing none of them. Time. This is the one nobody lists. You need the same hours every day for months. If you can only watch the market twice a week, you're not going to build the pattern recognition this requires. That's not a character flaw, it's just a scheduling reality worth knowing before you fund an account. For a small account, the version that makes sense is the micro. MNQ is 1/10 the size, $2 a point, 50 cents a tick. Same market, same chart, same behavior, 1/10 of the risk. That's a genuinely good place to learn. Futures also trade nearly 24 hours, 5 days a week, so you're not locked into one window. And there's no PDT rule, no borrow to locate when you want to sell short. Whichever you pick one and stay with it for a year. That's not a popular thing to say because it sounds slow. It is slow. It's also what works. Here's the order I'd actually do this in. Phase 1. Don't trade. Open a sim account and just watch the open. 9:30 to 10:30 Eastern, every day. Write down what you notice, where it opened relative to yesterday, whether it drove in one direction or chopped, where it turned around. You're building a baseline. You cannot recognize an unusual day if you've never watched a normal one. Phase 2, Sim 1 setup. 1. Not a system with 6 conditions. One specific thing you've seen happen repeatedly that you can define in a single sentence. Take that setup and only that setup. You will be bored. Boredom is the correct feeling, and most people quit right here. Journal every single trade. What you took, why you took it, where you got out, and what you were thinking. This is the least fun part of this business, and it is the thing that separates people who improve from people who repeat the same mistake for 2 years. Now, here's the part I want to be specific about, because most beginner advice gets this wrong. Everyone tells you to paper trade for a few weeks. That's the wrong instruction. If you sim on a calendar, what happens is you paper trade for 6 weeks, learn nothing in particular, and then go live on schedule anyway because the calendar said so. Sim until you have an edge, not until a date. An edge is a specific, repeatable reason you think price is more likely to go one way than the other that you've tested enough times to trust. So the bar to leave sim is 3 things. One setup you can define in a sentence, 30 to 40 log trades on that setup, and a record that shows it actually works, not a feeling that it does. If you don't have those 3, you're not ready, and it doesn't matter how many weeks have gone by. One honest thing about sim, though, it cannot teach you the emotional part. Same setup, real money, different person. Something changes in your head when it's real, and there's no way to simulate that. That's exactly why the next phase exists. Phase 3, go live tiny. 1 micro contract, 1 or 200 shares. Size so small the money genuinely doesn't matter, because the point is not to make money. It's to find out what changes in you when it's real. Then, and only then, scale. I want to cover this because a lot of people getting into futures hear about funded accounts and think it solves the capital problem. So here's the straight version. A prop firm evaluation works like this. You pay a fee. You trade a simulated account to a profit target inside a set of drawdown rules. If you pass, they give you access to funded capital and you split the profits. That's a real thing and it's a legitimate path. But here's what I want you to hear. An evaluation is a test of an edge you already have. It is not a shortcut past building one. If you don't have a tested setup and a logged record, an evaluation isn't going to give you one. It's going to charge you a fee to find out you don't have one and then charge you again for the reset. And the honest number? Most people who buy an evaluation fail it. That's the business model. The fees are real revenue for these firms, and they're not refundable. So, after you've got a profitable sim record, prop firms are worth a serious look. Before that, they're an expensive way to skip a step you can't actually skip. I'll do a full video on how they work, which ones have real payout track records, and what to look for in the rules. And full disclosure, I'm an affiliate for some of these firms, which means I get paid if you sign up through my link. I trade live every morning, Monday through Friday, with my prop firm account if you would like to join us. The prop firm I currently use is Funded Seat, so you can go to fundedseat.com and use code PIT for all the best deals. 4 things. 1. Open a SIM account. Today. It's free. 2. Pick one market and write it down. 3. Watch the first hour, 5 days in a row, without placing a trade. 4. Write down what you saw each day. 3 sentences. That's it. Do that for 1 week and you'll be further along than most people who funded an account this month. That's the honest starting point. I'll go deeper on each piece of this. The levels I mark before the open, how I actually read the first 15 minutes, and the risk math for a small account. Everything I look at before the bell goes into the brief. Links below if you want it. And this is educational content. It's not financial advice, and I'm not telling you to buy or sell anything. Remember to like and subscribe, and I'll see you in the next one.